In today's video, we are going to take a look at some policy loans, and we're really going to take a deep dive. We're going to look at specifically how loans impact a whole life insurance policy, specifically in terms of the cash value. We'll look at the policy performance, what the cash value is growing by each year, but then we'll also look at what is the true cost to borrow. A question that a lot of people have, I see this a lot with the real estate investors and some people that own businesses and use their policies for their business is, what is my true cost to borrow? I want to see exactly what I am paying in loan interest to the insurance company, and I would like to compare that with what my money is growing by each year. So I can see if I'm in the black, meaning I'm getting more than from the insurance company than what I'm paying them, or if I'm in the red. And what we'll look at today specifically are two different loans. We'll look at a variable loan rate, which will be a non-direct recognition policy. We'll explain exactly what that is. And then also a fixed loan rate, which will be a direct recognition policy. So we've got the two main pieces here when it comes to whole life insurance, what people are typically interested in. Number one goal, maximize the cash value growth. That is where I recommend you always start, because if the cash value is maximized, when you begin to look at policy loans, you've got the most amount of money to work with from start to finish, which is very important. But what we'll focus on today is using the policy specifically with loans. And why people are interested in this is because my money continues to compound even when I take loans against it. So my entire bucket of money keeps on moving forward. You'll see a demonstration or several demonstrations of that today. So what we'll begin with is looking at a policy without any loans. We'll see exactly what the dividends are, the dividends that you're receiving with this policy, and then we'll also look at the total cash value growth. And I say that because anytime you see a dividend column in a life insurance illustration, that does not reflect the guaranteed interest. This can be confusing sometimes. So what we like to do in a case like this is show the dividends, but then also the total cash value growth. You'll see exactly what I mean when we pull up the illustration. So we'll look at that first. And then what we'll do is look at that exact same policy, but what it looks like when we take loans with a policy that has a variable loan rate. So a variable loan rate typically results in a non-direct recognition policy. What that term means, non-direct recognition, is the fact that when you take a loan, the company does not recognize the fact that you take a loan with regard to how they apply dividends to your policy. So what it means is if you're earning $5,000 in interest for the year, if you take a policy loan, you're still going to earn $5,000 in interest. It's the exact same number, regardless if you don't have any loans outstanding against your policy or if you have the maximum loan outstanding. The insurance company pays you the same amount of interest. You'll see that when we pull up the model. But what we'll look at here is the impact that the loan has on a policy while the loan is outstanding and also after it's paid back. And then we'll look at the cost to borrow as well. Then what we'll do is compare that exact same policy with a fixed loan interest rate. So we're going to look at an insurance company that offers both a variable and fixed loan interest rate. It's a Mass Mutual product because they offer both. And if we elect the fixed loan interest rate, the policy is direct recognition. We'll do the exact same thing. We'll look at the impact that this loan has on your policy and the net cost to borrow. The rates, you'll see them when we pull up the numbers, but with the variable loan rate, it is currently just over 5.7%, and fixed, it's 6% flat. A fixed rate is fixed for the life of the contract, so that is not going to adjust. And then what we'll do is compare the two options side by side. So this will be a really good case study because a lot of people are curious about this. Typically what happens once we understand whole life insurance and how it works is we get that the cash value is a great place to put money. I like it because it's safe, liquid, and tax-free. However, when it comes to policy loans, there are some different options. And really what I want as a policyholder is to understand the differences. This way I don't go with an option based off a recommendation and then find out, oh man, I wish I would have went with option B, but option B was never thoroughly explained to me, or I was never even shown option B. I just want some transparency here. So the purpose of this video is to provide exactly that. So let's get on into it and have some fun. We'll begin with the detailed illustration, as this will provide a breakdown of where your money is going, and this is the design of the policy. So when we pull up the numbers on Excel, it's based on this. This is the policy we modeled everything with. So what we've got here, a 40-year-old individual, annual funding, $100K per year for 10 years, total of $1 million paid into the policy. There's your money column. First year, just about 90% of your payment shows up in cash value. How we do that is by getting the base premium about as close to the minimum as we can drive it with the insurance company we're working with. So it's 10% of the total payment. There's our base premium. We've got term insurance riders and such attached, but this policy is maximized for cash value, break-even point, year 4. What I mean when I say break-even point is by year 4, you've paid a total of $400,000, 100K per year for 4 years. And that's the first year you have more than $400,000 in cash value. Why we don't break even in year 3 is because you've paid in $300K and your cash value is about $292. You have less than what you've paid in. So this is the growth illustration. We also have the loan illustrations as well, but we're just going to focus on Excel because it's a lot easier. Loan illustrations on an insurance company's formal illustration, there's a lot of columns and such, which if you work with us, we'll always provide that to you. But for this video, we'll just focus on Excel. So let's begin with what we just looked at there. So here's that same illustration. And actually, let me go back for 1 second. Annual dividend. Look at year 10, $39,000 and change. Okay. And then look at year 11, when you pay nothing, $40,000 and change. When we go back to this guy, what do you notice? Everything is identical because it is the exact same policy. So there you go, funding, 100K per year. That's your premium and PUA payment. Total outlay tallies up every year you make a premium and PUA payment. There's the break even of year 4, paid in 400, you have 400. Then we've got this. This is the total dividend. This is the column we saw on the life insurance illustration. Do you remember what year 10 was? $39,000 and change. How about year 11? When you paid nothing in. $41,000 and change. Here's why I'm highlighting those numbers. Year 10, your cash value is what? Just about $1.2 million. You pay in 0. Your out-of-pocket is literally 0. There's no premium or anything like that. The cash value is $1.26 million. What's the growth there? Is it $41,000, which is what the dividend column showed on that illustration? No, it isn't. Here's the true growth. Net cash value growth, $62,000 and change. This column is not on the life insurance illustration. Some companies will provide additional reports that display this. Some companies don't. What I really like to do is this, where we just provide this number on Excel or in some manner so we can see the true gains that we received on the policy that year. Because the dividend column does not include the guaranteed interest. When we look at the total growth, it's the dividend plus the guarantees as well. So this is your true growth each year, what we have in purple. That'll be important when we compare it to loans because I want to see what? What is the policy growing by compared to what I am paying in loan interest? So let's do that, and we will look at the variable loan first. So item number 1, check onto the variable loan. To begin, on the left, you've got exactly what we just looked at. There's the funding. This is the exact same policy. Column in the purple is the net cash value growth each year. Okay. Variable loan, 5.72%, a non-direct recognition policy. In this example, we're going to do a couple things. First, we'll take a $1 million loan. You can take policy loans anytime. Most people do take loans while they are funding the policy. I did it in year 11 just because it's easy. I'm not making any more premium and PUA payments. So when we progress through the different columns, you can see, okay, when I took this loan, I'm no longer funding the policy, so all of my attention is being directed to the loan now. Money coming out and then money going back in. So I take the $1 million loan. Okay. Let's look at the impact of that loan before we look at payments. In dark red is your loan balance. Next, we've got your cash value, $203,000. We also have your death benefit, $1.23 million. Compare that to the examples on the left. Do this in a different color. Death benefit in year 11, 2.289. Cash value, 1.26 million. When you borrow, what happens? You take a $1 million loan, the cash value is your equity. If you're used to using real estate, think of this as your line of credit, equity that you have access to. So you take a $1 million loan, your available equity that you have for additional loans is now just over $200,000. What's held as collateral is the death benefit. So this is reduced by about $1 million when you take that policy loan. So if you die with a loan outstanding, this death benefit represents the net payout that goes to your beneficiaries. Okay, now, staying on year 11, before we look at the payments, there's your dividend column. What is it over here? No change. Remember that term, non-direct recognition? That means the company does not recognize the fact that you have a loan outstanding with regard to how they pay you dividends. So the dividend never changes. That's constant the whole time a loan is outstanding and when a loan's paid back. There's no change there. So what we'll see in a case like this is when we begin to repay it, our cash value will be restored, but you'll notice when everything's paid back, I'm exactly where I would have been as if I never took a loan in the first place. So we take our $1 million loan. Then in this example, we begin to repay it at $100,000 per year. See what we did here? We took the loan, and then instead of funding the policy, we're just redirecting that same cash flow toward the policy each year. You see a lot of guys and girls involved in real estate do this. So of that $100,000 per year payment, here's how much is applied toward the principal in purple. And then in red, light red, is how much of your payment is applied to the loan interest. What I like to do here, let's focus still on year 12. What did you pay in loan interest that year? $57,000 in change. What did we receive in total earnings from the insurance company? $65,000 in change. Our earnings are exceeding the cost to borrow in this particular case when we just isolate the dollar amount. That's good. That's what we want here. And where this is particularly helpful is when we look at it, if I just looked at the dividend column, makes it look like the opposite is true. But no, I want to look at the net cash value, which we sometimes have to calculate on our own, or if you're working with us, we do it for you. But my point is, that's important when we're looking at the numbers. Now, as we repay it, you can repay it however he'd like, but he repays it at $100K per year. And when the loan is repaid, what do you see here? Cash value, 2.842. 2.842. Death benefit, just under 4 million. The figures are identical across the board in the scenario where I don't touch it versus the scenario where I take that $1 million loan and pay it back over a long period of time in this example. When it's repaid, however, I see that my money has continued to compound the entire time in the exact same manner as if I never touched it in the first place. So that's what attracts a lot of people to cash value life insurance when it comes to using the policy. Does that make sense? The one thing that can impact your values here, not your cash value so much, but the cost to borrow, is this guy. The fact that that loan rate is variable and it has changed over the past couple of years. As interest rates were very, very low, and they have come back up over time. So a nice alternative in that case is to consider a fixed loan interest rate. So let's do that. Number 3, we'll look at the same policy, but with a fixed loan interest rate. Here we go. So on the left, exact same thing. This is what I always like to look at, because when I take loans, I can see what's the change if I just let it sit and grow, if I never take a policy loan. So here we go. In this guy, we take that same $1 million loan in year 11. There's your cash value, 208. There's your death benefit, 1.24. There's your dividend come, $49,000 and change. What's it over here? $41,000 and change. It's higher. So with this particular company, their direct recognition treatment actually results in a higher dividend rate on loaned dollars. So with a direct recognition policy, what will happen is when you borrow against your policy, the insurance company still applies dividends and interest to any money in cash value and also any money outstanding in loans. However, the dividend applied to the loan portion is different than the non-loaned portion. In this particular case with MassMutual, they raise the dividend rate on borrowed funds. Not all companies do that. Some will reduce it. In cases like that, if they reduce the dividend, what I've seen is they often have a lower fixed loan interest rate, but the treatment is different. The net cost ends up being about the same when you look at the amount of interest I spent compared to what I received in dividends, but there is a difference, and people often do have questions. They just want to understand it for themselves, which I fully get because I'm the same way. Point is here, when that loan's outstanding, your dividend's higher. We repay it at the same pace, 100K per year. We see how much is applied toward principal in purple, and then how much is applied toward interest. When it's repaid, there's your cash value and death benefit compared to the left, cash value and death benefit. What happens here? Is it higher or lower? It's higher because you receive that higher dividend over time. So with this guy, we actually see more money when we borrow and repay. The item that can throw this off is not the loan interest rate. With non-direct recognition, the loan interest rate will likely change. With direct recognition, this will stay the same. However, if dividends go up with the insurance company, what that can result in is their direct recognition treatment changing. For example, if we go back almost 10 years where the dividend rate was 7.1% with MassMutual, they still had the same fixed loan rate of 6%, but what you would see is when you took policy loans, the dividend applied to the borrowed portion was less than the current dividend rate. So they can adjust that, which is important to be aware of. But it's a pretty cool option when we look at it. It's different, and a lot of times people aren't aware that a direct recognition company can and will sometimes raise the dividend on outstanding loan funds. A lot of older Guardian contracts do this. Northwestern Mutual with their older fixed loan rate does the same. But that is our direct recognition policy. And real quick, what we can look at too, because this question does come up, is these numbers, like, do we see this on the insurance company's illustration? The answer is yes. We pull this directly from the insurance company's illustration. So there's your annual dividend column. What I'll focus on here is just that year 11 when we took that policy loan out, $49,000 and change. The dividends will be the same all the way down. Okay, so that was fun. Let's compare the two side by side and see the net dollar difference there, meaning which option is more favorable to me as a policyholder. So what we've got is the non-direct recognition example on the left, and then the direct recognition example on the right. Exact same chart that we looked at. Net difference is on the far right. We'll start with the cash value difference. This is going to show how much more or how much less you have in cash value with the direct recognition policy compared to the non-direct recognition policy. It's exactly the same when no loans are outstanding because it's the exact same policy. Where it gets different is when we take that loan. So what I see, the first year I take that policy loan, I've got $208,000 in cash value. Compared to the non-direct recognition example, I've got $203,000. Why it's higher? Because of that. I got a higher dividend there. However, what else is higher? The loan interest you paid. So the next column, interest paid difference, will show how much more you paid in loan interest with the direct recognition option and the fixed loan rate at 6% compared to the variable loan rate of 5.72%. So the first year I make a payment, $60,000 went toward interest with the fixed loan rate compared to $57,200 with the variable loan rate. Net difference, $2,800. And there will be a difference every year. This column is going to tally up the total difference here. So when that loan is repaid, what's the net difference? You paid about an additional $47,000 in loan interest. However, how much more do you have in cash value? $134,000. What's the net difference? We'll highlight this in yellow. $87,000 in change. What this does is take how much more you have in cash value, then subtracts how much more you've paid in loan interest, and there's your net. So based on this present illustration, you would walk away with $87,000 more by year 27 when you've paid in the total of $1 million with the direct recognition policy option. Here's the thing, in the years of doing this, these numbers always change. My opinion on non-direct and direct recognition is I don't think it makes much of a difference because we see the net difference here almost always work out in the wash or come very, very close to each other with non-direct and direct recognition policy options. As the years pass and dividends go up and how companies treat their direct recognition loans, that's going to impact this. If we were to do the same case study a year or two ago, say 2 years ago, where that variable loan rate was close to 3%, what's going to happen? You're going to spend a whole lot less in loan interest, and then that net difference is going to be very, very close to a wash. So my point is there's typically not a huge difference there. What we usually like to focus on with individuals is first getting the policy right in terms of A, maximizing the cash value growth. That's most important. But then B, making sure that the policy is also flexible. This is typically the most important piece to individuals. Meaning if you want a policy like what you just saw there, where you can fund $100K per year, a lot of times people want to do that, but they do not want to receive a bill for $100K every year. So what you can do, depending on the company and their flexibility, is set it up where you're committed only to your minimum premium, which is about $10,000 per year. And then you can add PUAs at your discretion, which in this example would be the additional $90K. You're not required to do that. All companies have different rules when it comes to PUA flexibility, but that I think is a lot more valuable in terms of company and product selection than the loan treatment. At least we see people put a lot more value there, and it's getting money in. If your cash flow fluctuates, that is huge, and just knowing the differences between insurance companies and such will help with that. That and an actual policy performance, making sure we have a company that has proof of performance, actually delivers, not just shows good-looking numbers on paper. Anyway, I'm going to stop talking now. I hope you enjoyed this video. Please let us know if you did. As always, I hope this helps. Thanks so much for watching all the way through. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.